Okay, so I'll do just a short introduction. So thank you all for coming. Thanks, Robert, for coming. He actually flew in today, and he doesn't have much time, so we should be really appreciative that he came. Apart from this lecture, we are also doing a couple more lectures. We are calling it trading meetups. So if you are not yet signed up and you would like to sign up, please do. It's on our website. Those will be short or workshops and lectures for smaller groups of people, roughly 20-25, and we have quite a lot of interesting talks lined up. And we would like to keep it private, because if it's private, the people can share more interesting information than if we do it publicly available for everyone. Little bit about Robert. He's right now an independent trader. He used to work for the AHL, which is a CTA fund, if I'm correct. And right now he blogs under Investment Idiocy. So I don't know what's the exact URL. It's Q something.
My main website is systematicmoney.org.
Oh, but you also have the blog.
Yeah.
Okay.
The blog is quapac.blogspot.com.
And yeah, also one thing I would like to mention, we bought this book, and there was a competition. So whoever was the closest, we will probably know the winner in 5 minutes or so, but we'll announce it at the end of the lecture.
What was the competition asking?
It was to give us the estimate for the pound-crown rate. I think it's right about now. Okay, we already know the price, so we probably should know the winner as well. And that's it.
Okay.
So if you can, please welcome Robert on the stage.
Thanks, Oscar, for inviting me to this very interesting room. I noticed that we've still got the red phone from the Cold War era. So if Mr. Trump's going to launch a nuclear attack, we will actually know before anybody else, because that phone will ring and he'll be at the other end telling us. So that's great. Okay, so who here has actually done or developed any kind of trading strategy, or done any back tests or anything like that? Put your hand up. Okay, a few of you. Okay. So the way that people design trading strategies is actually kind of crazy. And a really good analogy for this is to think about the way that cars are built. So if we built cars the same way that most people design trading strategies, what we would do is go into the factory where all the parts are, all the wheels, all the bumpers, all the lights, and just drag all the parts out, and then get a team of robots to assemble all of those parts in every possible combination. And we'd end up with some very strange vehicles. Some would have one wheel, some would have four, some would have no wheels at all, some would just have 6 steering wheels on the outside. There'd just be all kinds of weird things. But some of them would look a bit like cars. And then what we do is put those cars on a racetrack and see which one had the fastest time over a half a kilometre drag race. And we'd say, yes, that is the best car. Now this is clearly ridiculous, and that's not a car that you'd want to drive in. But actually that's pretty close to the way most people design trading strategies. They filter through permutations of trading strategies, and then they pick the one that does the best on a very narrow performance metric. And I'm going to try and explain to you why that's kind of crazy and kind of a better way of doing it. Are you supposed to read that? Yeah? Okay. Okay, so I first got into this business about 16 years ago when I was 27. Most of you are probably now thinking, wow, it's much older than it really is, but sadly it's true. 16 years of working in the financial markets, which included 2008, having 3 children, this is what it does to you. So when I started in this business, I kind of had a very naive idea about how trading strategy development should work, systematic trading strategy should work. And I kind of had this idea that I think most people have is what happens. So can everyone see the magic red dot? Yeah. So you start with some data, and then you put it through some kind of magic fitting box, and out comes a trading strategy. And a trading strategy has 2 components. It has an algorithm, which essentially is a set of rules, and it has some parameters, which are numbers that kind of tell those rules how to behave. Okay, so why is this a bad thing? So any kind of fitting process, statistical fitting process, is sort of good in small measures, but bad if you do too much of it. And it's very well illustrated by this graph. So the x-axis here shows model complexity. So this can be how many parameters we have in our model, how many degrees of freedom, if you understand that term, or how much fitting we've done. And the dark line here shows the prediction error on the data that we're fitting. So basically, the more fitting you do, the less prediction error there will be, until at some point you can actually describe the data you've got perfectly because you've got huge amounts of parameters in your fitting. The problem is, of course, that we don't actually get to run our trading strategies on the past because we don't have access to time machines. Instead, we have to run them out of sample in live trading. And this grey line shows how well things do if we do that. So the first thing to notice is the grey line is always above the red line. So we always do a little bit worse, generally speaking, out of sample than in sample. And the other thing is that instead of this does gradually improve, but then suddenly it starts going up again. So beyond a certain amount of complexity in our model, we get worse and worse out of sample performance. And there is some point of optimal complexity. So there's some point of optimal amount of fitting that you should do. And the bad news is that most people really overestimate where this is. You know, they think it's over here somewhere when really it's probably more like here or here. Okay, so there are three kinds of fitting. So most people probably think of fitting in a very explicit sense. So an explicit fitting will be you have, and there's a very kind of fashionable way of doing that these days called machine learning. Which you can tell from the sarcasm in my voice, I'm not a big fan of. So machine learning, is the idea is that the fitting is all done automatically by the machine. The computer itself learns what the best parameters are. There's also a kind of fitting called implicit fitting. So implicit fitting is where you sit down and you fit your trading strategy and you see how well it performs, and then you say, oh, I can do a bit better than that. So you circle back, and then on the same set of data, you make a change, and you test it again, and you get better performance, brilliant. And then you circle back, and then you do the same thing again. So the machine's not doing the fitting, you've done it yourself. But you end up with the same results. You end up with the same thing, which is essentially you looked at a set of data and fitted your model really closely to it, and potentially pushed yourself to the point where you're overfitting. The difference between these two is you know when this is happening because the machine, you can see the software running doing it. With this, you can kind of fool yourself that you haven't overfitted, whereas you have. Now, finally, there's tacit fitting, and tacit fitting is something most people don't even think about, but actually is a big part of this presentation, so I'm going to try and explain it. So if I sat myself down at a computer to come up with a trading strategy, even without looking at the data, there's a certain number of ideas I would try first, because I just know there are certain things that work in the financial markets. And that's what I call tacit knowledge. It's knowledge that exists in my brain. And because I'm going to sit down and try things that I know already work, I'm effectively already fitting, because I'm excluding all the ideas that wouldn't work. But I'm still using information that I wouldn't have known in the past, because it's just information I know, it's maybe stuff I've read in books, experience I've had. So examples of tacit data. Sorry, I keep going backwards and forwards. I find this very unintuitive, I don't know why. So things like theory. So we're sitting in this fine university where presumably people are taught lots of things about financial market theory. So things like, Markowitz, portfolio optimization, and Farmer-French three-factor models. There's also previous research, so we can go on the internet and we can see papers published by academics, but also by white papers by industry professionals saying, oh, look, this works, this works, this works. There's what I would call market folklore. So this is stuff that hasn't necessarily been published, but everyone in the financial markets knows about it. And it's just known about, it's just that no one's got around to documenting it. It's not really a secret. And finally, there's what I call common sense, and I'll maybe give you some examples of that later. Okay, so the argument that I'm going to make today is that rather than trying to fit a trading strategy, so get all of our metaphorical car parts out of the factory, throw them together in all kinds of random combinations, and then see which does best on a very narrow test. That we should design our trading strategies. In other words, like people design actual cars and all other products. And the way to do that is we're not going to get away from the fact that we've got tacit knowledge. We're actually going to use that tacit knowledge to help design our trading strategy. We're going to avoid implicit fitting as much as we can, because implicit fitting really is the most dangerous thing you can do, because you can't control or know what degree of overfitting is going on. And finally, we are going to do some explicit fitting, because explicit fitting is relatively safe and controllable and quantifiable. But we're going to do it the minimum amount of it, and we're going to do it the right way. And the key thing here is we're not going to start with a bunch of data. Remember the start slide with a big black cloud of data? We're going to start with ideas. So I call this ideas first rather than data first. So how do I design trading strategies now that I'm really old? So I start off with some tacit knowledge, and then I have a design process. And the design process uses does use data, but actually uses a lot of fake data. And actually used to call this random data, but Mr. Trump has made me think that fake data sounds much better, so I'm going to say I'll call it fake data now. But I will use some real data as well. And you're probably wondering how fake data helps, and that will become clear. And this again goes into my design process. Now notice that before the fitting box was a black box, and this is a clear box. So I'm obviously making a point there about the fact that it's a transparent process. And then out comes again the strategy, which consists of an algorithm plus some parameters. And this is just kind of opening up that tacit knowledge and saying, well, these are all the things I'm thinking about when I do my design process. And there's going back to the original analogy, this is how people design real products, right? So they do have theories. So if you're going to design a car, you're going to start off with some physics about aerodynamics and things like that. They use market research. They look at previous products. They use their own personal taste, and they use focus groups, which are other people's personal tastes, and they build prototypes. Just don't go straight to the final model. Is everyone with me so far? Any questions? Because I have a habit of talking really fast, and most of you probably speak excellent English, but it's not your first language, so this gentleman here.
I just want to ask about the fake data. You just generate the fake data, say it like something.
All will become clear on the fake data. Yeah, I'll give you an example of fake data. Any more questions? At the back?
By any chance, would be this presentation available anywhere, so we can get back to those ideas presented?
These two.
If you agree, we can upload it in the event.
There you go.
Okay.
So you can play it really slowly and pause it and say, what did he mean by that? Anything else? Great. So, okay. So I get pigeonholed a bit as a trend follower, and I don't know if you know this in financial markets. There's this big war between people who are into trend following and people who aren't. And I don't really consider myself a trend follower, but unfortunately, having worked in a trend following firm and having written a book in which I describe trend following as one possible way as you can predict the market, and I do have a bit of trend following in my portfolio, I do seem to be a bit pigeonholed about it. But anyway, I'm going to talk about trend following mainly for the reason that I do know quite a lot about it, and I think I understand it reasonably well. But this, the techniques I'm going to talk about are applicable to pretty much any kind of trading strategy idea. So what sort of tacit knowledge do we have about trend following? So we have some market folklore. So these are kind of phrases that you'll hear if you've been around a while. Cut your losers and let your winners run. Don't fight the tape, which means the same thing. There's the story of the turtle traders, who are these guys who were kind of selected randomly and trained to follow a particular trading system like 35, 40 years ago and made a lot of money. And there's a kind of a tradition of CTAs, so commodity trading advisors, who trade this kind of product. And there's sort of two separate traditions. So there's what I call the US tradition, which is companies like Campbell, Chesapeake and Dunn Capital. And then there's a bunch of firms in the UK that all grew out of AHL, which is the firm I used to work for. The biggest of which is now Winton. Aspect is also run by another exponential guy. And there's also a European kind of stream as well, so there's Transtrend and Systematica, which used to be London-based, but now Swiss-based. There's also a whole lot of academic research on this. So I think the oldest paper I could find was Levy in 1960, and then there was some stuff in the 90s, and momentum was added as a fourth factor to the classic three-factor equity model in 97. And finally, there's some theories as to why momentum works, why this idea of buying something that's gone up in price, hoping it will go up some more, works, and vice versa. And the one I'm most compelled by is prospect theory, which is the theory developed by two Israeli psychologists, one of whom won a Nobel Prize, and who wrote this excellent book called System 1 and System 2, which you should definitely read. Michael Lewis has just written a book called The Undoing Project about how these guys work together, which again is a really good book. And there's other kind of cognitive psychological biases as well. And there's also the fact that certain kinds of big funds in the market tend to behave in a way that reinforces trends. So if things have been going up, they buy and vice versa. Anyway, the point is, you'd have to have been living under a rock for 40 years not to have known any of this stuff. Okay, so trend following is a well-known thing, has a lot of tacit knowledge associated with it. Okay, so we're going to build a trend following system, but we've got a whole bunch of questions we need to answer. So, okay, well, what period of time do trends last for? We're trying to capture trends that last for minutes, or hours, or days, or weeks, or months, or years. When should we enter those trends? When should we exit those trends? Should we have a stop loss rule? And if so, what is it? How do we identify markets that are or aren't trend friendly? In other words, ones that trend well and ones that don't. Sorry? How do we identify how strong the trend is? And what size should our positions be? And all of these can be summed up in those two questions that we keep seeing on the flow charts. What is the algorithm and what are the parameters of the algorithm? Okay. The data first approach, remember, is we get the data and we have a huge set of possible algorithms and a huge set of possible parameters. And they go into the black magic fitting box. And the magic happens inside the box, and out pops the best algorithm and the best combination, the best parameters, the best combination of these two things. So, data first. Remember, the classic way of fitting trading strategies is like building this car in this really weird way. First of all, you're looking at one thing. You're looking at the best return versus risk in the data set you've got. And if you assume that leverage is possible and risk is Gaussian, that's the same as having the highest Sharpe ratio. If those things aren't true, you can use other measures. So there's two important points here. The first is that there's a single metric, a single way, a single test of what is best, and that's performance. So that's like the 500-meter drag race. We're just doing that one thing and saying, yeah, that's the best car. It's a very narrow view of what makes a good trading strategy. And we only have one source of information we use to make that decision, which is the past data of the strategy. So the ideas first approach, which I advocate is better, is you want the best design strategy. So you don't have one metric, you have many metrics. So you look at performance, but you also look at turnover, how often it trades, what its behaviour is in given scenarios, and so on and so on. And that's like saying, well, the best car isn't necessarily the one that does 500-meter drag race the fastest. It might be the one that's got the best fuel efficiency, is the most attractive, it's got the best features. Best is a very nebulous term. And the second thing is that you don't just use one source of information, you use different sources of information. So you use this tacit knowledge, common sense, theoretical principles. You also use fake data and limited amounts of real data. Everyone happy? Good. So, we're going to follow a 6-step plan. Okay? We're going to start with a framework, which opposes some conditions. We're then going to come up with an idea. Now you may be wondering why these two aren't the other way around, so that'll hopefully become obvious. It's called ideas first, not ideas second, isn't it? So, we're going to then use some random data or a single scenario of real data plus some theory and common sense to develop the algorithm. We're then going to use some fake data to fit, in quotes, because we're not really fitting, because it's not real data, but we sort of are, the algorithm. We're then going to use real data for sort of parameter sensitivity and sense check. So the important point about that is we're not going to be looking at performance at that stage. It's going to be how well does this algorithm perform under real market data conditions. You know, how does it behave rather than how well does it do. And then finally, we are going to fit our risk allocation to that algorithm using real data in a proper, you know, this is explicit fitting, so we're going to do it properly. Okay, let's start with the sound framework. Okay, so framework basically means that when you don't develop when you develop new trading strategies, you don't have to reinvent the wheel. Okay, you don't have to develop, you know, so within that typical trading strategy, there's a huge number of parts to it. And the idea is you stick with a framework that's very generic. And that happens to be one of my first books, if you haven't got one of your own. It's fairly generic. And then there are all kinds of rules and ideas you can fit into that. And as well as being less work, the other advantage of that is it reduces the amount of development and fitting we need to do on any specific strategy, which is really important. So this is just a generic framework that I use. It's reasonably good for trading certain kinds of markets. So we start with a number of trading rules, which we apply on one or more instruments. So we've got S&P 500, Eurodollar, and corn futures. And on basically for each of these rules and markets, we create a forecast. So trading rule 2 will have a forecast for these 3 markets. Trading rule 3 will have a forecast for these 3 markets. We then combine the forecast from the trading rules. So we've got a forecast for each market. We'll have a forecast for S&P, forecast for Eurodollar, forecast for corn. At this point, I'm not saying what a forecast is, but that will become clear. We then do some risk targeting, position sizing, and we end up with a portfolio, and we decide, you know, what actual positions, how many actual futures contracts we're going to hold, or shares of Apple, or units of Bitcoin, or you know whatever it is we're trading, and we decide how many to hold and what trading to do. The details aren't very important. It's the fact that you have a framework that's important. So this is the conditions of my framework. So there's a lot of words on that slide and some maths. So we'll go through this quite slowly. And if anyone has any questions, just jump in. So, trading rules make forecasts of risk-adjusted price changes, okay? Forecasts are continuous, not discrete entry and exit conditions. So in other words, the system doesn't work like this. If something happens buy, then if something else happens sell. It doesn't work like that. Every day or every minute, or however often you're trading the system, it comes up with a continuous forecast for a particular instrument. So it might say, you know, strong buy, weak buy, flat, sell a bit more, sell a bit more. Okay, so it's always got a position on in theory, as long as it's not, you know, got a flat forecast. It's always in that particular market. The forecast is proportional to the expected Sharpe ratio, which is the mean divided by the standard deviation, because the Sharpe ratio is just a measure of risk-adjusted return. And from like standard portfolio theory, that means the position is proportional to the forecast divided by the standard deviation square, which is the variance. Don't worry about this stuff; doesn't matter too much. There is a scaling factor in this thing, which means that the expected absolute value of the forecast is 10, and that can be any number. We just need to come up with a number. I just like 10. In principle, all forecasts will be used in all markets. So in other words, in principle, trading rule 1 will predict all 3 of these markets, trading rule 2 will predict all 3 of these markets, and so on. So we are, in this framework, we're looking for rules that work across a variety of different markets, unless there's very strong evidence to believe otherwise, yeah? And the reason to do that is because we want to ideally pool as much data as possible during the fitting process. And if we can have lots of different instruments, then we can do that. Yeah. Okay, so we're going to use multiple variations of the same trading rule to capture different time frames. So you know I said earlier, are we looking for trends over 1 day, 2 day, 5 day, a week? Well, in principle, we're looking for trends of all different lengths. And we're going to use different trading rules to try and capture each of those effects. And we're going to have quite a few of those, but we don't want to be too highly correlated because there's not really a point in having lots of things in our portfolio with correlations of like 0.999. Costs are very important. The most important thing in any kind of trading strategy development is costs. And the second most important thing is costs. You know, they're really, really important. Costs are very predictable. Pre-cost returns are not predictable. So we're going to throw away any systems that look just too expensive to trade. We're also going to throw away any systems that trade really, really slowly. And that's because we know, kind of theoretically, because there's something called the law of active management, that when you're trading really slowly, you can't expect to make very good returns. You might just buy and hold or just be an investor rather than a trader. Right, any questions on that? You're either all very clever or very shy about asking questions.
No, I would like to ask.
Yes, please.
Like, if I understand it right, each moment, like every minute, like the system backward like analyzes the situation and gives some number like from -1 to 1, which like represents the likelihood of like upward and downward movement.
Exactly.
Yeah.
That's a really good way of describing it.
And like, what's the advantage of that approach? Like, instead of like some categorical data.
Good question. So the question for the camera and everybody else is really, what's the advantage of using a continuous rather than a discrete approach? So there are a number of advantages. For the purpose of this presentation, the main advantage is that you don't have to have a separate entry and exit rule. You just have one rule that says how big is my forecast. If you're trading in like quite decent size, and in my last full-time job I was trading, you know, like literally tens of billions of dollars of positions, okay, then you cannot just go from being fully long to being fully short in 2 minutes. You cannot do it. The market will just back away from you. You'll end up losing a lot of money in trading costs. So you want to be able to adjust your position smoothly. Now, if you believe, it seems quite reasonable to assume that that a forecast should have some information in its value as well as its time. So to me, if a forecast is weak, it should mean you shouldn't do very much. If a forecast is strong, you should have a bigger position. And sometimes in retail trading, this is called pyramiding. So you sort of buy, if the market goes up, you pyramid, you add more to a position, and so on. And the reason that makes sense is because if you have a weak trend that then becomes a strong trend, your position should be increasing, all the things being equal. And you can do scatter plots to convince yourself of this. So I get to use the blackboard. Excellent. So what you do is something like, on the x-axis, you plot your forecast, which remember is proportional to Sharpe ratio. And on the y-axis, you plot your response. So this is the ex-post return, risk-adjusted return, for that particular forecast. So you might say, oh, look at how prices moved in the week after that forecast was made. So this is expected, and this is the response. Now, if you're correct, sorry, that's unfair. If a binary system makes sense, you'd expect to see this kind of effect. So the moment the forecast goes positive, the response jumps up here. In other words, getting a stronger forecast has no information in it, yeah? What you actually see is a fit. Oops, put into no multicolored chalk, never mind. What you see is a fit more like this. So you do see a linear response. So as the forecast gets stronger, the response gets stronger. So what's that saying is if you can, you should actually trade continuously, pretty much. Now this is an oversimplification because this is basically a regression fit on a very, very noisy plot. But that, for a good trading rule, that's what you'd expect to see. If you see something weird and non-linear, it's probably an indication it's not a great trading rule. Does that make sense to everybody? Good. Right. Any more questions? Yes, sir.
Are the binary or discrete rules used in the industry somewhere, like among the bigger names you mentioned on earlier?
So, I mean, for example, if you're a high-frequency trader,
yeah, like
you'll probably use a binary. You'll probably use a binary rule because you're probably only going to be trading quite small amount, discrete amounts at a time, and you'll be like in, out, in, out, in, out. That makes perfect sense. If you're trading options, binary can make sense because the options kind of do this for you. So imagine if you thought the market was rallying, you'd buy a call option, and then as the market rallied, your delta would increase. You'd actually get more exposure, so you don't need to worry about doing it yourself. It kind of just happens. Yeah, I mean, it's simpler to run a binary system in many ways, to run a discrete system in many ways. It's simpler to think about. So a lot of people who've come from like more of a kind of discretionary trading background and moved into systematic trading tend naturally to use that kind of system, whereas people who have come from academia and designed something from scratch tend to use more of a continuous rule.
I meant more like the bigger names you mentioned, original, like the QuantCon and these. Like I assume in AHL you didn't use it since you don't.
Yeah, I mean, as far as in this kind of trading strategy, I mean those firms now, big multi-strategy businesses, do lots of different things. But in this kind of trading strategy, I'd imagine pretty much all the big names are using a continuous system. Pretty much, yeah.
Thank you.
Okay. Right. So remember, these are the unanswered questions from earlier. And the reason why we develop a framework first is because we can now do this magic trick. We can do that magic trick. Yeah. So the framework everything I put a red line through, the framework deals with it for us. Yeah. So the framework basically leaves us with only one unanswered question, which is how do we identify how strong the trend is? So basically, that will then give us our forecast. Yeah. The framework will then deal with the size of our positions. In principle, we trade all markets. We don't need to worry about trend, unfriendly or friendly. The framework will deal with that. There is no stop loss rule. Because we're trend following, we'll automatically get out of positions when we're losing money. So we don't need an explicit stop loss. If we were doing something different, we may want to think about adding an explicit stop loss. But there's no need to add one here. So we don't need any kind of exit rule, in fact, or any kind of entry rule, because we're doing this continuous system. We're not worried at this stage what period of time trends last for. We're going to assume that trends happen at different scales, and then we're going to basically develop rules that match each of those specifically. So the good thing about using a framework is there are fewer open questions, which means there's fewer parameters we actually have to fit. And we're going to be trying to design rather than fit here, but it's still useful. Okay, so that's the first step. The second step is to come up with the idea. Okay, so what are trends? I mean, what does a trend look like? So this is a trend that those of you who are not too young will be familiar with. So this is the S&P 500 from January 2007, January 2008, January 2009. So basically in 2007 nothing much happened, and then in 2008 there was a very big downtrend. I think that's pretty well known. So as human beings, it's very easy to look at these kinds of graphs and see these patterns and even get out our rules and draw these lines. So the question is, what's a good way of actually drawing this line? That's basically what we're trying to do. We're trying to say, how do we draw trend lines, essentially? Now, there are lots of different ways of doing this, and actually the way I prefer is to use something called a moving average crossover. But I decided to use something different for this, because I wanted to approach this exercise with a completely fresh mind and not be in any danger of polluting the design process with my tacit knowledge specifically about moving average crossovers. So in as much as I could have a blank sheet of paper, I wanted to have that. So I decided to use something else, which is just to basically do something, and those of you who studied in this building will recognise this as a standard OLS regression. So basically, we're just going to try and fit. If you think about each of these daily closes here as a point, we're going to try and fit the line that best fits that pattern of daily closes. Okay? So it's an OLS regression where the price is the y variable and the x is some measure of time, like number of years, for example. And we're going to get two coefficients. One we don't care about. The other one is the beta, or the slope of the line. And if that line is positive, the price is going up. And if the beta is negative, the price is going down. And we're going to use a rolling regression over the last n weekdays to capture different trend lengths. So in this slide, we used a year, but we can also take much shorter periods. So we could actually say, draw a line here, which is about a month worth of data, or even here, which is about a week. So that means we've only got one parameter to fit, and that's the window size, how long the regression is. We don't need to fit anything else because the framework has handled all the other details for us. So we've reduced our problem to a very simple one. Everyone got that? Yes?
What is the difference to regular momentum if you are looking at the rolling regression for n days? What is the difference to just be looking at the momentum as a loop back? Is there any difference, or is it very close?
What do you mean as a look back?
Well, if I would be looking for if it's plus or minus as a performance for the day, what would be the difference to using rolling regression for that same period of the time?
The main there's two different. Okay, I understand. I think I understand. I'm going to ask you I'm going to give your question back to you. You can tell me if I've got your question, and then I'm going to answer it. Okay. So you're saying, why can't I just do something like this? Take this point here, which is the beginning of the year. Take this point here, which is the end of the year, and effectively draw a line. Basically say, is this point lower or higher than this point? Exactly. Well, the first thing is you need to get a measure of the strength of the trend, but that's easy enough, I hear you responding. All I need to do is compare the value of this to the value of this. So that gives me the strength of the trend as well. So, I still don't see why you can't just do a simple look back, yeah? The reason is that it's more robust to do this. So it's more robust and it responds more slowly. So let me give you an example. So let's assume we've got a really nice trend developing. Yeah. And then on day 5, Trump says something and the price crashes. Okay, actually let's make it crash, let's put it down here. Okay, so we've got 5 data points, yeah? With your method, we basically do that. Say, oh, it's a downtrend, yeah? With the size of that. Now, with my method, we'd fit the best line we can to these points, which would probably be something like this. So it's still an uptrend, but it's not very sharp. Actually, it would be probably a bit flatter. So it's still an uptrend, but a much less modest one. Now, the reason we want to do that is we're basically, it's only the red line, I can point at it. We're basically saying that this is just one data point. Yeah. We're basically basing our trend with your method of just 2 data points. With the regression, we take the whole of the history into account, so it's more robust. We're trying to pick up trend. We're using a 1 year look, using a longish look back. We're trying to pick up trends that maybe happen over slow periods of time. We don't want that to be influenced by just one data point. Apart from anything else, the trading costs will be enormous because every time this happens, you'll want to sell everything, right? I'm pretty sure if I backtested your idea and backtested mine would be better, which is a kind of a, so there argument. But it's theoretically it's better. I refer to common sense at the start. To me, at least, common sense says that using a regression or something that takes into account all the points is better. Now, before I finish, I said I prefer using something called a moving average look back. And the moving averages that you use in that normally are exponentially weighted. So exponential weighting would basically say, I'm going to take all these points into account, but I'm going to give the most recent points a higher weight and the past further back a lower weight. So it's kind of a compromise between between your world and my world.
No, I fully agree. As long as you do the averaging the one way or the other, you could do the look back for, I don't know, quarter, month, year, and average it down, which will be very similar to, it will be just the time frame.
Yeah.
The more you will average, the better you will avoid the spikes in
yeah.
results. Yeah, thank
you. Good question, a really good question. Just because I disagree with you massively, it's still a great question. Okay, so we're on to step 3. Is there any time limit on this, or I didn't ask?
The time?
No, is there a time limit?
Yeah.
I think we'll start leaving on that. I've probably gone on too long.
Until 4, but you can go.
Okay, I probably shouldn't take that long. Okay, step 3. use some random data or a single scenario of real data plus theory stroke common sense to develop the algorithm. Okay, so what does that look like? So let's use a single scenario which is 2008, and let's just see what happens if I literally take all the data points of 2008 and I draw my regression line and I measure the slope. And the slope is minus 564.1 points per year. So if you believe this trend would continue, then the next year the S&P would have dropped by another 564 points. Well, you know that didn't happen, right? Trend following is not always correct. But it's just nice to do this, just to see what a forecast would look like. Of course, in this case, your measure would give an almost identical response. So there's probably not that much in it. Right, now, remember, we had all of these conditions that we imposed as part of the framework. And the key one here is this. Forecasts are scaled in an instrument, temporal, independent way, no magic numbers. What this means is that you should be able to use the same forecasting rule across time and also across different instruments. And it's clear that using the regression is an epic fail as far as this goes, because minus 464 points only makes sense in the context of the S&P in 2008. If I went back to the 1980s when the S&P was at about a third of this level, or a quarter of this level, then on a kind of relative basis this number is way too big. If I look at another market like, I don't know, US 10-year bonds, which at the moment are priced at 140, it's mathematically impossible for them to go down 564 points in a year. So the rule fails in terms of being able to work across different markets, across different periods of history. So we need to fix that. So remember, we want forecasts which are proportional to the mean divided by the standard deviation. Well, beta is already in units of a price change. So if I change my forecast so it's beta divided by the standard deviation of the price, where standard deviation is measured as the annual standard deviation of price changes, then it works. And there's no need to, we didn't need to build a big backtesting engine to work this out. We just looked at the equation, looked at the one example, just used common sense and said, yeah, okay, this is how we fix this trading model up. We don't have to rerun a backtest and risk overfitting to see if this works better. We still haven't checked how well this rule performs. We're just designing the thing. We haven't taken our car anywhere near a racetrack yet. Okay, so I've made that change, and now what I'm doing, I've plotted here the forecast for S&P 500 from 98 to quite recently. So this is the actual forecast value. So when it's negative, we're bearish. When it's positive, we're bullish. So what kind of behavior am I looking for here? Okay. First of all, I'm looking at the scaling. So I'm not too bothered at this point about the actual numbers on the y-axis, whether it's got the correct scaling, because actually the framework, the software in the framework deals with that for me. But I'm looking to see if this is consistently scaled over time. So for example, if I had a forecast that looks like this, right? So it starts off with a very low volatility, a very low value scalar, and then gets bigger and bigger and bigger over time. I know I've screwed up. Okay, this I need to go back and look at my trading rule again. But that hasn't got this behavior. It's in a pretty good range. Next thing I want to check, does the behavior make sense? Does this rule do what I'd expect it to do? It's a trend following rule. So it should be bearish after a bear market and bullish after a bull market. So at the beginning of 2009, it's very, very bearish. At the end of the tech bubble, it's very bullish and then goes bearish. What else? You can see the rally after the big market crash there, and then another rally in 2013. So it's kind of doing what I expected to do. So, if this was the other way around, I'd be worried. I would have made a mistake. Yeah. Next thing, Is there anything weird going on here? Could anyone see anything weird in this plot? Give you a clue. Can you see it here on the left? Is that really weird spike? Right. Sorry, it's obviously a really bad plot. So at the beginning here, the thing spikes up to like a value of 70, whereas most of the time it's in a range of plus minus 20. And what's happening there is if we do an LLS regression on a very small number of points, we haven't got very much data, we get quite extreme values, and that's exactly what's happened here. So what we need to do is put in some kind of constraint saying, unless we need a minimum amount of data before we start running this rule and fitting. And you know, again, I'm not going to fit this, I'm just going to say, right, I'm not going to do a regression until I've got at least the window size divided by 4 number of points. So for example, if I want to do a year look back, window size about 250 trading days, then I want to have at least 250 divided by 4, which is 62, 63 days before I produce a forecast. Anything else? No, it's probably pretty good. So I've gone through a lot of the stages of designing my algorithm, and I've not used any data. I've used this one example of real data. I haven't looked at performance. I've just made decisions based on common sense, on old theory. Sorry, I'm going backwards again. Okay, everyone with me? Any questions? At the back.
Could you describe how, for the previous graph, how the rule or the algorithm really looks like? Is it some kind of decision tree? Is it neural network, or how it looks like on paper?
Okay. The rule looks like, take all of the points, take all the closing prices, daily closing prices, work with daily data, draw a regression line through them, which gives me a slope, a beta, that's scaled in price, change in price units. Then I divide by the volatility of the price, the annualized volatility of the price in the same units. So probably the annualized volatility of the price in this period was about 200 points a year, probably. So my forecast is 564 divided by 200, which is, sorry, I've missed a factor of 10 out somewhere. But the answer comes out about 20, minus 20.
So your forecast is minus 20 in 256 days, or is it the window for how long is predicted? Okay,
good. So what basically I will do in practice is every day look at the last 256 days, assuming a window size of 256, right? We're going to deal with smaller windows too. So every day my computer wakes up, gets the last 256 days of closing prices, runs the regression, checks, estimates the volatility, calculates the forecast. Yeah? Next day repeats. Obviously we've lost 1 day of data here and gained 1 day of data here. So the forecast is going to be very similar. Repeat, repeat, repeat. That's all it's doing. Yeah? Everyone's clear on this, because when you start to make decision trees and stuff, I'm like, well, hang on a second. This is way simpler than that. You've clearly got the wrong end of the stick. I haven't explained this very well. Everyone's cool with the rule, yeah? Good. Right, so now we can move on to using fake data to fit the algorithm. So, back to our conditions of our framework. We want to use multiple variations of the same trading rule to capture different time frames, as many as possible, not too highly correlated. Costs are very important. We throw away expensive systems, and we'll throw away systems that trade just really slowly, because we might as well just be buy and hold investors. So, what value should we actually use for this single parameter window size? How are we going to do it? We're going to follow a 4-step process. First of all, we're going to try and get an understanding of how trend length relates to profitability of window size. So for example, if I'm trying to capture trends that last for a week, what window size should I use? If I'm trying to capture 6-month trends, what window size should I use? And so on. The answer may seem obvious, but it wasn't actually to me. But it's worth checking even if it's obvious to you. get an idea of how quickly different window sizes will trade, because we're really concerned about costs. We don't want things to trade way too quickly. Prune any window size that are likely to be too expensive. So if we check and we find that using a window size of 3 or 4 or 5, or anything less than 10, gives us prohibitively high trading costs, at that point we can say, right, we can just throw away all of those window sizes. We don't need them anymore. We're not going to even think about them. Again, prune any window sizes that are likely to be just way too slow. So after this, we're going to have a range of possible window sizes, maybe from 10 to 200. And in theory, any possible, we could be trading with 190 possible window sizes. But then we're going to look at the correlation structure of each of these guys and work out, do we need all 190 of these things, or could we just have 6 or 7? And if so, which 6 or 7? And we're going to do all this with fake data, so we're not going anywhere near any real data. We're not running any back tests of performance. Okay, you asked about how we generate some fake data. Your question is now answered. Okay, so basically what I want to try and do is create things that look a bit like trends in financial markets. And the way to do that is start off with a sawtooth pattern generated to give the length of trend that I want. So in this case, I want 1 month trends. Actually, slightly less than a month. Is it a month? Okay, it's about a month. So I draw a sawtooth that goes up for a month, down for a month, and so on and so on. And then I add on some Gaussian noise, and I end up with something that looks like a trend. And it turns out that varying the amount of Gaussian noise has no effect on the relative performance on my different window sizes. It affects the absolute performance because the more noise I add on, the less clear the trends become. But it doesn't change the relative performance. So trust me, I have actually run these results on different amounts of Gaussian noise. They do not change, but I'm not showing you all of them because there'd just be too many numbers. Okay? I mean, there's already too many numbers, right? Imagine if, let's look at 7 pages of this stuff. Right, so what does this mean? Okay, so the columns, each column shows a different fake trend length. So trends of about a month, trends of about 3 months of working days, all the way up to about a year of working days, 256 working days. Each row shows a different window size, so 5, 10, 15, blah, 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 and you can see what that equates to in real money. So 5 business days is a week, 21 business days is about a month, and so on all the way up to a window size of 256. The numbers are Sharpe ratios, and they are average Sharpe ratios because this is all done on fake data, so it's randomly generated, and you don't want an individual random value that comes out, a random, diagonal sawtooth pattern with noise to influence the results too much. So you actually do this lots of times and then take an average. It's a standard kind of Monte Carlo technique, effectively. Okay. So the first thing to note, the numbers are highlighted in bold. So these are the maximum values for each column. So these are the window sizes that give the best performance for a given trend length. So for example, if your trends last for about a week, then you really want to have a window size of about 1 or 2, start again. If your trend length is about a month, you ideally want a window size of about 1 or 2 weeks. If your trend length is about, I don't know, what's that, 6 months, then ideally you want a window size of between 21 and 64 days, and so on. And you get this nice pattern here. And it's kind of intuitive, so very, very, very roughly, the optimal window size is about 1/3 of the trend length, which may not be what you thought when your intuition was working earlier. So it's worth doing this exercise. The values in red are negative, and interesting here is to look at the really big negative values. So -11, a sharp of -11. Can you imagine that? That's like being the best high frequency trader in the world with a minus sign in front of it. Yeah. -3, -1.6. So these are what, where I used to work, we call the harmonic frequency of death. So it's where you're using a window size that's exactly wrong for the trend length. So for example, if your trends last for about a month, if you use a window size of twice that, you lose -11 sharp. And the reason why that happens is because basically you end up going buy, sell, buy, sell, buy, sell. Yeah, you're exactly wrong every single time you trade. The other thing to notice is that beyond about a window size of 192, we get performance that's either negative or, even for very slow trends, frankly, you know, just, I mean, sharp 0.2 is not worth getting out of bed for, frankly. It's not statistically significant for a start. So we can sort of look at this graph and know we can truncate it. We're probably not going to need these really slow window sizes. They're a waste of our time. Okay, the next thing we'll do is look at trading costs. So the first thing we need to measure is how often something trades. So we need a measure of turnover. So a turnover, my turnover measure, if it's a number of 52, means that basically we hold things for an average of a week, trading 52 times a year. And this has been collapsed down to a single column graph because it turns out it doesn't matter what the underlying trend length is, the turnover numbers are pretty similar. So turnover is pretty much determined only by the window size, not by the underlying data. So if our window size is 5, then our turnover is 176 times a year. So that means we're trading like every 1.5 days, which is pretty quick. And that goes all the way down to the last few numbers when we're trading about once every couple of months. And it's important to note again that beyond about here, these numbers don't change very much. So we're not really, it's not like we can say, well, it's worth trading these things because they're really cheap. Actually, they're barely cheaper than these things. So, you know, they're a waste of space. Now, turnover in and of itself is pointless unless you know how expensive the things you are trading. So what I did was, for two markets I'm trading, which are the most expensive future I trade, which is S&P 500, sorry, the cheapest future I trade, which is S&P 500, and the most expensive future I trade, which is Eurodollar futures, I calculated the costs in basis points per year in Sharpe ratio units based on those turnover figures. So you'll notice, quite handily, 176 for a window size of 5 translates to 17.6 basis points of cost per year of Sharpe ratio on Eurodollar and 176 basis points of cost per year on Eurodollar, because there's a factor of 10 between these. If I talk about things like trading costs and Sharpe ratio of basis points per year, does everyone go, yeah, I understand what you're talking about? Is anyone going, what? Anyone go, what? Everyone happy with that as a cost measure? It doesn't really matter, to be honest. The main point to note is obviously small window sizes trade really quickly, and if the thing you're trading is expensive, it will cost you money. And for reasons that you'll need to read chapter 12 of my first book for, I personally use a limit of 13. So basically, I will not trade anything where this number is bigger than 13. That's the main message here. So this stuff in bold is fine. So for S&P 500, window size 5 is too expensive, and everything else is fine. For Eurodollar, actually you need to get down to window size 85 before you can afford it. The point here is no matter how cheap your instrument is, there's absolutely no point having a window size of 5. Because even with the cheapest thing I trade, it's still too expensive. So we can prune that, yes, at the back.
Sorry, I don't get why it's so cheap. Is it because some exchange fees or something like that?
So it's basically costs are commission plus market impact slippage. Commissions are, and that's all done on a volatility normalized basis. So S&P 500 is cheap for a few reasons. The cost to trade one futures contract, for me at least, is actually the same, so it's not really that. But S&P 500 is more volatile, so the kind of cost of volatility is lower than the Eurodollar. And the bid-ask spread, again, when you look at it on a volatility normalized basis, is also lower in S&P 500. let me give you an example. I did this calculation the other day. So if you look at the bid-ask spread of S&P 500 futures and Bitcoin, which you follow my Twitter feed, you'll know I don't like. Bitcoin has a bid-ask spread that's about 40 times larger than S&P 500 futures. But it's also 5 times more volatile. So on a volatility normalized basis, Bitcoin is only, 8 times more expensive than S&P 500 futures. So it's still really expensive, but not as expensive as you think. Maybe you can come and talk to me later, because everyone else is either like, that's really obvious, or what is he talking about? I think they fall into those two camps. So they'll be getting nothing out of this discussion. And to be honest, it doesn't really you don't really need to understand this. The main point is, if this number is bigger than 13, and this number just comes from some magic place, then we can't trade it. Okay. So we've answered most questions, but we're still left with a large possible range of window sizes. And actually, you know what, I haven't even included every possibility here. So what about window size 19, or what about window size 111? It turns out, and if you're really smart, you can prove this with a pen and a piece of paper, that for two window sizes, for two window sizes where one window size is √2 times bigger than the other window size. So for example, if you look at the correlation of window size 10 and window size 14, which are about √2 apart, 1.1414, then the correlation between the forecasts of those two guys is about 0.9. And the correlation between any window sizes that are further away is always less than 0.9. What that means is that basically, if we say, well, you know what, we're not interested in anything that's got correlation of higher than 0.9, there's no point in trading window size 10 and 11, or 10 and 12, or 10 and 13, because those are all going to have a correlation bigger than 0.9. It's worth trading 10 and 14, because they've got a correlation of 0.9. But then you don't need 15, because that's going to have a very high correlation with 14. You need to go up to the next one. So you actually end up with steps of 10, which is the cheapest we can trade, 14, 20, 28. So these are all √2, 1.4 times the previous number, basically. And remember, anything over about 200 is just a waste of time. Anything less than 10 is too expensive. So we end up with the following set of 1, 2, 3, 4, 5, 6, 7, 8, 9 window sizes. So we've gone from window size could be 1 or it could be infinity. And we said, okay, window sizes less than 10 are too expensive, even if we're trading the cheapest thing we have. Window sizes over about 200 are just a waste of space. And in what's left, if we take out everything that's got a correlation of bigger than 0.9, we're left with these numbers here. And we've done all this without looking at any real data, without doing any back tests, without doing any fitting. Questions? Yeah?
You said that you generated the data with the Gaussian noise, which will have like normal distribution of reference. Have you tried it, or different method which yields different distribution curve, like more closer to stock price, like log normal?
Yeah, you could do it with different distributions, but to be honest,
does it make a difference?
It's not going to make a big difference. I'm just trying to think. It's possible that if you had a distribution, well, actually not even distribution, if you had a process, like a process that had big jumps in it, like the sort of thing you'd use for trading, options, pricing options. If you had a process with really big jumps in it, it would make the trading costs of the small window size and the big window size compress. Because what would happen is every time there's a big jump, both the slow and the fast window size trading wall would trade. I haven't tried it, but intuitively that was what would happen. Offhand, I can't think of any other thing you could do to the distribution that would make the results that different. Or, it would go back to what I said earlier. It would change the absolute performance of all of these things, but the relative performance would stay the same, and that's what we're interested in. At this stage, we still don't know whether any of these things actually make money in reality, right? We haven't got to that bit yet. I've got tacit knowledge that it will work, but you know, I still don't know. You had a follow up.
Yeah, it's like the different with the negative sharp ratios with the other ranges.
Yeah.
What about like turning the rule upside down and actually go short, you go long, and vice versa?
Everyone does that, right?
So there has to be something that doesn't.
Yeah, yeah. You know what? If you can find a price series that looks like this consistently, then absolutely, you should be trading, you should be selling here and buying here, and trend following in between. And you'll be the richest man on earth in about 6 months. Because you'd have a positive sharp of 11. Yeah. So, yeah, that's the problem, right? These things do not exist in reality, unfortunately. It's just a thought experiment. The other thing is, if you're operating, this is actually an important point, right? So if you think about the two philosophies I outlined at the first slide, data first or ideas first. As a data first investor, if I find a rule that is really badly, I wouldn't actually, because the computer would always find the positive version of it, right? If the parameter set was big enough, it would find the rule with the sharp of plus 11 or a ridiculous number and say, yes, trade this. As an ideas first person, you start off with something like an intuitive idea of how the world works. And if you then find that the only trading rule that works is something that does something completely opposite to what you thought, you don't go, well, fantastic, I'll just trade the opposite. You should go, well, hang on a second, my model of the way the world works is wrong. And actually, I need to go back and think about that. You know, you wouldn't just trade something just because it makes... The whole point of this presentation, you know, in fact, the whole purpose of my entire life is to avoid people going into this trap where they basically trade stuff just because it makes money in a back test. Yeah. Okay. So great question, but never do this. Right. So
it's more like to point out that either your idea is wrong or you made a mistake on the way somewhere.
Well, exactly. Yeah, it could mean that you've screwed up your code. Yeah, I mean.
But if you had like wishful thinking in
yeah.
then you would monitor.
Yeah. Right. Sorry, I went far too far back. Now I'm going to go forwards. Okay, I think we're in the right place now. Yeah. Right. We're now going to use real data, but we're not going to check performance. We're still not doing a kind of classic back test with a sharp ratio. Instead, we're going to do what I call a parameter sensitivity check and a sense check. Basically, what we're going to do is, firstly, we're going to see, we've got this set of window sizes. We're going to see, in like a real data scenario, how sensitive, you know, those parameters are. So if we use a window size of 11 rather than 10, does that make a huge difference? I don't think it would, but it's worth checking, right? The other thing is to sort of say, was my fake data realistic enough that it's given me parameters that still a model that behaves in the real world the way it did in the fake world? Because I may have just come up with fake data that has the wrong features. So the first thing I'm going to check is the scaling. So remember, I'm concerned here that I have things that work consistently across different markets and also across time. I'm not showing you the across time here, but trust me, I've checked it. I'm just going to show you the across markets. So these are my different markets, these are my window sizes. And this number is basically the scaling factor which converts the natural amplitude of the forecast into the forecast I actually want in my system. Now, you may notice that these numbers are small and these numbers are big. And that actually is nothing to worry about because the framework will actually correct for that. Because what it will actually do in practice is pull these numbers together and calculate on an out of sample basis a corrective scaling factor will correct this problem. And we'll end up with forecasts that have the same scale no matter what the window size is. That's not a problem. But what I am concerned about would be if these numbers were radically different. By the way, the reason this happens makes perfect sense because if you think about we're doing a regression of a price series, as the price series kind of carries on, the slope, the more data, the longer the window size, the bigger the slope will be relative to the volatility because one's growing with T and the ones growing at root T. That either made sense to you or it didn't, it's not important. It's just to point out that you would expect this behaviour of increasing numbers. So all we're concerned about really is, are these numbers consistent across markets? And basically, they're all close enough that I wouldn't worry. You know, they're pretty close. Okay, the next thing I'll check is the turnover. So what I want to check, remember earlier we had some numbers for turnover. Shall I go back? Is that a bit risky? Let's try it. So for example, for 10 we had a turnover of about 75. Right, so you remember the number 75. And for 150 we had about 7.4. So you remember 7.4, okay? I just can't remember numbers. So what do we have for 10?
75.
So with the fake data we had 75, here we've got 80 with real data. So that's pretty close, right? So I think I'm quite pleased with that. And with 140, 150, what was it? 7.5? 7.4. So, and it was a look back between about 150 and 140. So you have to actually remember two numbers, sorry. But basically, it's consistent. So I'm happy that the decisions I've made with fake data, choosing trading rules based on their turnover on the fake data, I'm happy with those decisions. I have no reason to change those decisions or do this fitting or design process again on real data because the numbers are close enough. Costs. Now, confusingly, the numbers here are the same numbers earlier divided by 100. Do not ask me why I did that. I cannot remember. But I will try and let's see if we can get this to work. Okay, so for S&P 500 with a look back of 10. Right, so can 4 people in the audience basically remember these numbers, okay? So with a look back of 10, S&P 500 had costs of 7.5, and on the new graph that's going to be 0.075. Euro dollar will be 0.75, and on 150 it'll be 0.0074 and 0.074. Okay, try and hold those numbers in your head. Okay, so this was 0.0074, rounded up to 0.1, yeah? Yeah. I think those numbers are pretty close. They ought to be really, because they're just the turnover multiplied by the cost figures. The cost figures are the same, the turnover is close enough, so it's not going to be very different. It's just that we might see some weird, you know, that turnover is an average across all of the markets, whereas this is per market. So if there were any weird idiosyncratic market effects going on, we'd see them here. So I'm happy with that. And I've highlighted in bold everything less than 0.13, which is my magic cut-off point. That's just showing me that for euro dollar I can trade all window sizes. Same result with fake data. For euro dollar, sorry, I keep getting them the way around. For S&P 500 I can trade everything. For euro dollar I can only trade the slower ones because it's just expensive to trade. Okay? Okay. Hoping my voice will last for the rest of the presentation. Now remember earlier we did this pruning process and we said we don't want to have two rules that are correlation of 0.9 or above. So what I did was I measured the correlation on real data, average across the instruments that we've got, and I found the highest correlation between any two pairs of window size was 0.85, which is a bit less. And so firstly, that's close enough, it's pretty close, so I'm happy that the fake data have the right characteristics. By the way, I kind of have a theory of why this is 0.85 and not 0.9, which is that the fake data is so fake that it makes the correlations artificially high. Whereas in the real world, you never get trends that are that clean and that nice. So that's my reasoning for why it should be a bit lower with real data, but it's still pretty close. Okay, we are now ready, finally, to get our cars on the racetrack. So we're actually going to do an actual test with real data and look at performance. And we're going to use that for the purpose of doing explicit fitting. And what we're going to be fitting is the risk allocation, so the amount of money we put into each of these window sizes. And this is the first and the last time I will look at performance calculated using real data. So normally if you go to a presentation by someone like me, like the first slide will be like a picture of them with their dog, the second slide will be a load of legal BS, and the third slide will be a graph showing how much money they've made, right? So you're finally going to see the graph of the money that you've made. It's just right at the end. So remember, in principle, on the conditions slide earlier, all forecasts will be used on all markets. And it's at this point that we say, unless they're really rubbish. And we'll put more money into things that do better, the window sizes that perform better, if there's sort of statistical evidence to justify that. So the way the framework works is we have a combined forecast for each instrument, and the combined forecast is the weighted average of forecasts for different window sizes with some weights. And we've done some, remember we did work earlier to get all of these forecasts on the same consistent scaling, so the weights can just be meaningful. And the weights will be based basically on three things. So pre-cost performance, and I put different by market question mark because there's rarely actually strong enough evidence to suggest that these things do much better on one market than another. There is kind of some weak evidence that relatively fast trend following does not do well on equity indices like S&P 500 and hasn't done since about 1990 compared to, say, bonds. But it's still quite weak statistical evidence. You need decades of data to make these kinds of decisions. So if I was doing this, I'd personally I'd assume I'd take all of the market's pre-cost performance and average it out. Then there's the costs, and they're very different by market, as we've already seen. So if nothing else, we know that we're not even going to try using window sizes of 30 on Eurodollars. They're not even going to be in this equation here. And then finally, there's the correlation structure. So in any kind of portfolio optimization, you want to have a portfolio that's as diversified as possible, which means you want to have things that have got relatively low correlation. So that means remember, things that are adjacent in window size terms with a gap of root 2 or whatever, the gaps of root 2 are already in there. So 10 and 14 have got a correlation of 0.89 or 0.85 or 0.9 depending on the using real data. Then the next two have got a correlation of about 0.9. These two have a correlation that's less than 0.9. These two have a correlation of 0.9. These two have an even lower correlation. Yeah. So basically, the further apart the window sizes are, the lower the correlation will be. So the most diversified portfolio is going to be to own really fast trend following, really small window size, and a really large window size, because these two things are going to have the lowest correlation. Does that make sense? Yeah. So that means that you plot your W's. So if you go from a window size of, say, 5 to whatever our maximum is, 170, I think, on, say, S&P 500, which is cheap, so we can have all of these guys, then if you just look at the correlation and nothing else, you'll end up with a U-shaped curve. So you want to put a lot of money into things that, at the ends. These things in the middle here have all got quite high correlation, so you'd allocate less to them. When you consider the costs, it'll tend to tilt this thing away from the fast stuff. So even though we're happy to trade a 5-day window with S&P 500, because it's still quite expensive, it costs money, the costs kind of tilt this weight structure away, so it looks more like that. So we upweight slower things that are cheaper, and we downweight things that are fast. And then the pre-cost performance may change this again. But because statistically, of all of these effects, the pre-cost performance is the weakest. It's the thing we know with the most amount of calibration, if you like, chapter 3. We place a lot less weight on that. Anyway, that's just information that's not that important, but you might find it interesting. The main point here is this is a very well-known problem that people have spent decades thinking about. There are well-known problems with it. and if you're going to go to the talk I'm doing tomorrow at the Quant Expo, the talk is about that. And well-known solutions. But we have to do this because, remember, up till now we haven't looked at pre-cost performance, and there's still an awful chance that we might have somehow come up with a rule that's rubbish and that has a sharp of -11 when we actually try and run it. And this is the only way we can stop that happening. But we don't do it in a kind of implicit way by running the back test and seeing if it's rubbish and then taking it out. We don't do it in an explicit way by running a machine learning framework and doing it. We basically develop a set of trading rules that design a set of trading rules that make sense from all these other aspects. And only then, and only if we have statistically sound evidence, do we then actually say, well, actually, this rule is not very good. You know, we've designed all these cars that they're all well designed and brilliant. But when we take out the racetrack, we find one of them is just too slow, as it turns out. But you actually need like a lot of evidence to prove that. So. Okay, now some people may be saying, Mr. Carver, you are a hypocrite because you're going on about how optimizing fitting is a bad thing, and you say you hate machine learning, all these things, but you seem perfectly happy to optimize these portfolio allocations. But this is still an optimization problem, yes? It's still optimizing, it's still fitting. Why is one thing good and one thing bad? I mean, this is still bad, but it's not as bad. It's like the difference between George W. Bush and Donald Trump, right? They were both bad presidents, but one of them is turning out to be even worse than the other one. I was going to go to New York next year, but I'm guessing if this goes on YouTube, I've got no chance. But I've tweeted some nasty stuff about him, so if the CIA haven't picked that up, then, you know. Okay, so why is one good thing one thing worse than the other? Why, you know, these are like, I'm Catholic, and in the Catholic Church you've got sins and cardinal sins, you know, so there are things that are bad and there are things that are really, really bad. So why is fitting portfolio allocations just bad and not something you just have to do? And why is, you know, optimizing and fitting your model parameters really, really bad? So one reason is that in the portfolio optimization space, the parameter space is much smaller. So the degrees of freedom we have is relatively limited. You know, we've got a limited number of window sizes that we're choosing between. It's feasible to do rolling out of sample, so to never be doing in-sample fitting. It's because, you know, the optimization computation is relatively easy. This is a technical point, but the actual optimization surface is nicer, doesn't have weird bumps in it. There are well-developed techniques to cope with this. And the other thing is it's much harder to do implicit fitting. It's much easier to resist the temptation to do it when you're doing portfolio allocation, at least for me. So, and this kind of illustrates why. So when we actually do the exercise of saying from a window size of 10, which is the pink line, up to a window size of 160, which is the dark purpley line, how do these things do? And this is the sort of joint performance across all the markets we have. The reason why these lines are flat is because they're only trading one market, which is S&P 500, and my S&P 500 data doesn't start from 1998. So that's why these things don't work until then. So the reason why implicit fitting happens is because if your backtesting process is to generate these graphs, the first thing you're going to do is say, aha, these two aren't very good, I'll take them out. And you've just committed every cardinal sin in the book. Whereas what we're actually going to do is run a robust fitting process that allocates weights to each of these guys, does on a rolling sample basis, doesn't look forward, does in a robust way, which means that you would basically allocate something to these guys, and then less and less as they perform worse and there's more statistical evidence they're not very good. Anyway. And when you've done that, you end up with something like this, which is the kind of the final account curve. So to summarise, and then there'll be more questions if you want to ask more questions. There are three types of overfitting. There's tacit, where it's just stuff you know before you start working, so you only explore one part of the parameter space. There's implicit, where you generate curves like this. You generate curves like the ones we had a few slides ago. Yes, you generate curves like this, and then you drop ones that do badly, or you refine your model in some way and then circle back and fit over the same data. Or there's explicit fitting, which is kind of okay, where you do that computationally. You cannot get around tacit knowledge. You can't brainwash yourself before you sit down at a computer and start developing a strategy. So you should actually use that to design trading strategies. So you should start with a framework, which imposes conditions to reduce the amount of space you have to play with. Come up with good ideas. Use random data or single scenarios of real data to develop those ideas. Get some fake data from somewhere, follow this fitting process and design process. Then get your real data, check that your fake data was realistic. And then finally, do one final explicit fit of your risk allocation weights and do it properly. So, free advertising. Any questions? Yes?
I know that you are trading these strategies for a few years. Can you share the real experience in range markets? That's one. And second, if there is a sudden change in the trend, for example, 2015 S&P crash, I mean, sudden moves either at the tops, or if there is a spike move during the day, and how it, you know.
So
what's your real experience with these extreme
I guess the first thing to say is I'm not actually trading this system, right? I'm trading a bunch of things, none of which is a secret. It's all in my books or on my blog. And the closest thing I'm doing to this is momentum measured using moving average crossovers, which reacts differently. But the main theme is the same, in that you run a series of indicators that run over different time frames. So where you have range-bound markets, the faster indicators will tend to do very badly, because they, especially if they're the harmonic frequency of death, you don't get a sharp of -11. You'll lose money steadily, basically. The slower indicators won't do as badly in that scenario, but obviously if the market changes, they'll be slower to pick up on that change, slower to get into that position. So, you know, the thing about trend following as a strategy, it kind of belongs to a set of strategies where you're essentially losing money most of the time, and every now and then you make a lot of money. And that money loss could be because you're bleeding in range-bound markets, or it could be because the trend's flipped and you're in that period before your position size has also changed. So psychologically, it's quite difficult. And it's actually one of the reasons why I believe trend following will always work, because humans hate running trend following strategies. You know, whenever they see a price go up, they want to cash their chips and get out of the casino. Whenever they see a price going down, they want to hang on and make their money back. That's basically prospect theory, the psychological theory, cognitive bias. So I actually find it easier now running my own money than I did working in an institutional fund. Obviously the money's worse, the pay's worse, and it's my own money, so there's an additional pressure, but my system's fully automated, and I'm too lazy to do anything with it. I just let it run. And I've probably changed maybe 3 parameters over the last 3 years, and that was only when exogenous circumstances forced me to. I've made no kind of parameter changes or overriding or anything, and it runs automatically. It does all the trading automatically, and it's all automated. If the system was running in such a way that it sort of delivered me a set of trades I had to do, I'd probably find it much harder, because and in an institution where you have to be looking at the P&L every day, you have to be focusing on it, and you've got people ringing up saying why you're losing money. And it only really works well if you have a relatively small number of investors who all understand the strategy really well and are prepared to leave you alone. Otherwise, you end up getting their psychological biases kind of on a second-hand basis.
Isn't that exactly the reason why it's working? That it's sort of career risk, that people cannot just be bleeding out for 3 years on trend following and telling the investors that I'm underperforming.
I mean, the other thing is, you should never, I don't want anyone to leave this lecture hall and take all of their money and put it into trend following, because it's completely unsuitable unless you have another, you have a job as well. It's not very well suited to something where you need to make a consistent income every year even. I would say to anyone who's thinking about running a trend following strategy, expect to lose money 3 out of every 4 years. And you'll hopefully do better than that, but that should be your expectation, and you should be in a position to cope with that. So that's also why, in my own stuff, it's the allocation of trend following is about 60%, and the rest is other things that tend to have more consistent performance. But again, when you're in an institutional framework, you have to follow the kind of style constraints that the investors want. So they'll say, oh, we want you to have at least this much money in trend following, because that's what we want. That's what the better investors want. They want that kind of profile. There's a race. You at the back, because you've not asked the question yet.
Do you incorporate fundamental analysis in any of your trading algorithms, and if so, how?
So the question is, do I use fundamental analysis? So the answer is, at the moment, no. And that's not because I don't believe fundamental analysis works. It's just that it's very kind of manpower inefficient. So the amount of work you have to put into trading strategy kind of scales with the number of points of data you're collecting. So let's say I was trading a fundamental equity strategy. So I need to collect, book price ratios, dividend yields, all these other numbers, and then, those numbers have to be checked and possibly cleaned. You get data errors. Now I just have to check prices, just one thing. So as someone who's terminally lazy and doesn't want to spend time actually running a trading strategy and wants something that's fully automated, fundamentals don't make sense. But actually, my previous life, the very first job I had in hedge funds was actually running a fundamental global macro strategy. So that was using interest rate data, inflation data, unemployment data. So there's kind of there's three main types of data, right? There's the sort of what I call there's obviously price data, technical data. There's like macro top-down data, so that's things like unemployment, interest rates, inflation, and then there's like bottom-up micro data, which is like company-specific data. And yeah, if you've got the resources, then all of those are good sources of value. It's just that at the moment, I don't have the time and resources to run a fundamental strategy. Okay, you were next, I think.
Could you describe why you don't like cryptocurrencies or Bitcoin?
I mean, Oscar can tell you this because I was giving it on the bus. The main reason is kind of counterparty risk. So, like you look at what happened with Mt. Gox, like someone could just steal your money. You're not trading. You trade it's the Wild West. It's unregulated. I mean, okay, so the Chicago say they're going to list a Bitcoin future. If that gets enough liquidity, then I might consider it definitely. But the number one reason at the moment is there are just so many. Just because something's gone up a lot in price doesn't automatically mean that it's a great thing to trade. It just means it's gone up a lot in price, and I don't believe that it's probably a market that's dominated by idiots. And sorry if any of you trade or own Bitcoin, I apologise, but you're all clever and sensible people. But trust me, everyone else in this room who is in Bitcoin that isn't you is an idiot. So it's dominated by idiots. And some people claim that makes it easier. Like if the market's dominated by idiots, it's easier to trade. I don't really buy that argument, to be honest. I just think it makes it more unpredictable, and the basis of any kind of quantitative systematic process is assuming that the future will be a bit like the past. And the more unpredictable a market is, the less that's likely to happen. And the more a market's changing over time, the less that's likely to happen. So
Okay.
That's kind of. If you want a longer answer, then find me afterwards. I can go on for hours about how crap Bitcoin is.
Could we maybe do just one last question?
Okay, there was one over here, I think. Yes.
Myself. Hi Robert, thanks for coming to Prague. Just a quick reaction, it's not just what you said, it's also that Bitcoin is incredibly illiquid. So that's obviously a terrible point. The volumes in the markets are ridiculous. It still has a valuation of mid-sized S&P company. So it's not only about that, but it's also we explored it actually in our fund, and we discovered that even with a transaction worth like $40,000, $50,000, which is peanuts, to actually move the market and you actually don't find a counterparty on the other side to, to take the other side of the trade. So that's probably the major issue right now. And the second is that there's only a couple hundred people owning like 80% of that market, so they find it very easy to call it a market whenever they wish. So that would be that. Just a quick question to what you haven't really covered, at least I think, and that's a risk management part. Do you use any like value at risk, expected shortfall measures? How do you actually optimize for risk? Is it a Sortino ratio, something you use as well, together with Sharp, and fine tuning for the risk, or what other risk measures you apply?
Okay, so it's kind of 3 points. The question is about, well, first of all, he gave a speech about how rubbish Bitcoin was, just to benefit the video, and then he asked about risk management. So I'll answer the risk management question. So there's kind of 3 points to make. The first is that a good, well-designed systematic framework actually has a lot of endogenous risk management built into it. There's not really there's really a grey line between where you have position management and risk management. They kind of blur into one in a sense. So the fact, for example, that you'll automatically reduce positions when volatility increases is kind of risk management. The second point is that strategies which are positively skewed, like trend following, are relatively easy to risk manage compared to the opposite kind of strategies. So strategies which are negative vol, like selling vol, carry, FX carry in emerging markets, these things they've got more risk management challenges. The other thing is, of course, because we're trading momentum, there's a stop loss mechanism kind of implicit in there, so that's kind of in there as well. Having said all that, I do have a very simple risk management overlay on my own system, and basically it essentially looks at, so one of the things about this framework is there's like a long-term risk target, but then the system will make bets above and below that depending on how strong the forecasts are. So one thing it will do is look at the expected risk on any given day. If that's too high, which just means my forecasts are really strong, it'll start pro rata backing off. The second thing it will do is look at the expected risk, but this time it will assume all the correlations are 1 or -1. So this is kind of a bit like a leverage limit, and again it will back off, leverage in vol space. The next thing it will do is shock the volatility part of the covariance matrix and say, what if vol spiked to the 90th percentile of where it's been in the last 5 years? What would my expected risk be then? And again, it will do pro rata cutoff. And the other thing I do on a market-specific level, because as vol reduces, we leverage up. It says if the current level of vol is below, I think it's the 5th percentile, in other words, if vol's in the lowest 20th of where it's been in the last 10 years, don't use that vol number, just use the 5th percentile. So don't leverage, just ridiculously leverage up just because, like say 2-year German bonds, like a couple of years ago, the vol just vanished. The same thing happened in Euro yen about 5 years ago. You just don't keep leveraging up ridiculously, just stop leveraging up. So those are the fairly basic risk measures I use. And you can use stuff like VAR and all these other things. And in an institutional environment, people do that. But for me personally, I like to keep things pretty simple. So that's what I do. Are we done?
That's probably, yeah. Because we're like 10 minutes overdue.
Okay.
Thanks again for coming.